Well, hello everyone. My name's Chris Rogers. As part of Market Intelligence at S&P Global, I manage the Supply Chain Research Group. I'm delighted to be joined today by Agnieszka Maciejewska, head of our trade forecasting business as part of the global trade analytics business within S&P Global Market Intelligence. I also want to introduce to you Mark Fontecchio, the analyst responsible for Internet of Things research at 451, which is also part of S&P Global Market Intelligence in our TMT research group. So let's crack on to what the data is showing us. The first item that we've got here is the S&P Global PMI, the Purchasing Managers Index of different measures that globally manufacturers are telling us they're seeing in terms of conditions. Now, obviously, a lot of the challenges that supply chains have faced over the past few years have been a result of an acceleration in consumer demand at the same time as the disruptions caused by the pandemic. What we've seen more recently is a decline in consumer demand for goods, and that's led to a debottlenecking and unblocking, if you like, of supply chains. In terms of inventories, obviously the lack of availability of goods was one of the most visible parts of the supply chain challenges of the past couple of years. And what we've seen is after a move from a lack of supply of finished goods in 2020 and 2021, we moved to a slight surplus in the middle of last year. And we're now more or less back at normal in the aggregate for inventories. Now, bear in mind, that's global and that's taking manufacturing. What we're going to take a look at are retailers' inventories. Now, this uses data from S&P Global Capital IQ, our financial data platform. We've picked out a selection of companies in a selection of sectors to try and show you a little bit about how much divergence there is within individual sectors. The inventory to sales ratio in the second quarter of 2023. What we can see there is that for building supplies, the level of inventories is still well above what it was in the pre-pandemic era. And we've got a similar pattern there for personal computers as well. However, if we look at home appliances, so that's washing machines and microwaves and so on, they're a little bit above normal, whilst for fast fashion, they're actually back in line with normal. So what we're seeing there is that different industries are facing different challenges. Now, we're often asked whether this is a reflection of some industries moving to a just-in-case inventory pattern. And I would say probably not at this stage. Comments that we've seen from both the building supply industry and personal computing indicate that demand is depressed. As a result, it's not the inventory part of inventory to sales that's off kilter, it's the sales part. If we take a look at the seasonality of products coming through, so this is the seasonal shipping patterns in the US seaborne import space, that levels have more or less returned to where they've been historically in a similar pattern to where they were historically. Now, for those of you who said you're going to reserve judgment on the performance of supply chains until later in the peak season, I think that's the right way to think about it. The peak in shipments historically is around October, but we saw in 2022 there was early shipping, and in the end there was just too much. In 2021 there was also slightly earlier shipping, but of course logistics channels were gummed up. That's now not the case. And in 2020, well, speaks for itself. There's a lot of volatility in there. But speaking for where we are now, it looks pretty much like supply chain activity is back to normal for what we'd expect in the pre-pandemic period. Now, as I mentioned earlier, a lot of that's being driven by overall demand levels and overall trade levels. And I want to hand it over now to Agnieszka to talk about our forecast for trade over the next few quarters and into next year. Agnieszka, over to you.
Great. Thank you, Chris. Well, according to GTS forecasting provisions, there will be a growth in 2023, but it was not the case in quarter one. The quarter one 2023 results for the global trade volumes, the result was minus 1.3%, and we expect the volume growth in quarter two to turn out negative as well, around 0.6%. The growth should reach around 1 and 2% in quarter three and quarter four, respectively. So it should help in total 2023. The growth actually is weighted down by the effects of the war in Ukraine, stubbornly high inflation, the tighter monetary policy, and financial market uncertainty. And looking at the annual results, we can see that the slowdown in trade that we could observe in second half of 2022 continues in 2023. So it is still as in GTAS forecasting March release, the same as last quarter. The outlook for the second half is brighter, and all in all, the whole year is expected to amount to around 0.5%. Well, all the international institutions see those external factors that are suppressing the trade growth and are cautious in their 2023 estimations, but they may have a little bit more optimistic provisions for 2023. GTAS forecasting is already having the historical data for Q1 2023, as I mentioned, which is negative, and it is incorporated. And in our opinion, it doesn't seem likely like the total volume of growth would exceed 0.5% in 2023. So the seaborne trade is, of course, the largest mode of transportation in terms of volume. In 2023, it is estimated to amount to around 73% of the total volumes. In GTAS forecasting predictions, the sea trade is still downgraded by some factors like Ukrainian exports. Sea exports are only a couple commodities like corn, wheat, sunflower seeds, and so on, and they are not exported by 100% capacity. But the sea volumes were also elevated in our forecasts. So trade flows, mineral fuels from Russia to India, fertilizers from Russia to Brazil, or Russian imports of consumer goods from mainland China. So in total, the sea trade volume growth rates for the first half 2023 are around from 0 to 1%, but the second half of the year looks more positive with the growth rates. Those are, of course, growth rates corresponding quarter previous year, around 2%, and this is the contribution to the total volume growth in 2023.
Yeah, thanks, Agnieszka. I think it's, as you say, the slow recovery story is one that I think many of the multilaterals are more bullish than that. But not only are we not expecting wild growth, we've also got plenty of issues that we think you need to be aware of for the second half of this year. And sadly, a lot of these issues are also perpetual issues. So let's crack through a few of those. So first one, as Agnieszka just mentioned, is the ongoing conflict in Ukraine. Our country risk team believe that the conflict will continue for the foreseeable future under the Putin regime. Clearly, there are uncertainties around food supply chains, particularly given that Russia has indicated that there will not be a renewal of the Black Sea grain initiative. That's a potential worry as we head into the third quarter for food supply chains. The other area where we may see change is with regards to sanctions, and that will particularly be the case if we see any escalation in Russian activity from a military perspective, for example, in relation to Ukrainian infrastructure. The EU has just introduced a new set of sanctions, the 11th package. Those are specifically designed to target actions by third parties. So not just covering exports from the EU to Russia, but exports to other countries that may then ship them onwards, whether that's via the C2C shipment of oil or whether it's the shipment of other goods through third-party countries. Home appliances have been held up as an example of sanctions circumvention, so effectively shipping home appliances to Russia, not because Russians need new washing machines or new dishwashers, but because the components in them, including power control devices, and semiconductors can be reused as part of military products. What we can see here, just from the EU trade data, is that there has been a ramp up, quite a significant one, in shipments to Azerbaijan, Belarus, Georgia, Kazakhstan, and Uzbekistan, as well as an uplift in shipments to Turkey as well. Now, that's not an absolute sign of circumvention, but it does show that we can keep track of what's going on with some of these products via using the trade data, and that's something we'll continue to do in our research. The other policy area to watch, and this is something we've been flagging since the start of the year, is the implementation of a number of environmental regulations by the European Union that are really going to start to have an impact on supply chains. A couple of areas to bear in mind. First, the EU and US are in the throes of negotiating a green steel deal. So this is effectively looking to reduce the emissions associated with the manufacturing of steel. That deal, if it emerges, is due to emerge in October. The EU has also passed its Corporate Sustainability Directive. That's gone through the European Parliament and will now go to the member states to be implemented. That increases the requirement for corporate action in terms of managing ESG issues within their supply chain. And we've seen recently in Germany, the German government start to bring some cases with regards to the presence of forced labor within supply chain. So we may start to see that on a much wider basis as well. The Carbon Border Adjustment Mechanism, or CBAM, is being implemented this year as well. In October, companies will have to report their emissions within their supply chain in a number of goods, particularly steel and aluminum, and that will create complications for metals-based supply chains. Now, obviously, the precise impact on individual companies is something for those companies to talk about over the next year or so, but we will, I think, start to see more commentary on that in the fourth quarter as companies start to publish their data. And also, we'll be tracking cyber risks. Obviously, there were significant interruptions in 2020 and in prior years from cyber attacks, and there are concerns amongst our cyber risk team that the ongoing conflicts that we're seeing around the world may lead to increased cyber risk as well. That's particularly sensitive during the peak season. So with that, I want to bring Mark Fontecchio on. Mark, talk us through the survey that you've done and what you're seeing in terms of companies digitizing their supply chains.
Sure, thanks, Chris. As Chris said in the introduction, I'm an analyst at 451 Research, which is part of S&P Global Market Intelligence that focuses on disruptive technology. And one of the data products we have at 451 Research is called Voice of the Enterprise, which is a series of surveys of companies regarding their technology needs, adoption rates, challenges, use cases, and so forth. So the particular survey I'll be talking about today was released earlier this year. It was of 500 enterprises in the shipping and logistics sector. And that group of enterprises was split into three kind of basic categories. Number one, the shippers or the beneficial cargo owners. Number two, your 3PLs and other logistics service providers. And then three, the asset-based transportation carriers on your various modes of transport. So the survey focused on digital transformation trends for enterprises in that sector. One of the top takeaways from the survey was that 2/3 of companies in shipping and logistics said that they have a digital transformation strategy in place. So for an industry that has historically run on the adage that if it isn't broken, then don't fix it, this came as a bit of a surprise, although there can be some arguments that it was actually broken and they did need to fix it. So there are some variations in the data. You know, for example, larger organizations were more likely to say that they had a strategy in place. Nonetheless, overall, that high number was a bit surprising to us. We figured there could be a few key reasons for that. The first one being the most straightforward one, which is that shipping and logistics firms are indeed more likely to be undergoing digital transformation than in the past. But second, the term digital transformation can be just a malleable term, even if we try to define it in the survey. It's one that might mean something different on a company-by-company basis. So for some, it might mean a true bottoms-up approach to rebuilding and digitizing their business processes. But for others, digital transformation might just mean buying some pre-packaged transportation management system software. And then finally, we surmise that some portion of these organizations that said they have a strategy in place may be answering in more of an aspirational tone. That is, they're aspiring to be more digitized, and perhaps they actually have a strategy in place, but their execution of that strategy is still in process. Another thing that we ask in this survey is what kinds of projects they're deploying, what use cases that they have. And the use cases, the options that we give shippers or the BCOs are the same ones that we give the logistics service providers. And then for carriers, we kind of ask a different set of options. And so what we found is that there are a lot of back office type of use cases that were quite popular among shippers and logistics service providers. So looking at shippers' use cases and what their digital transformation projects were. You could see purchase order management at the very top. You also see projects such as capacity management and document digitization high on the list. And then back to that point of what digital transformation means to each organization, you even see that the improvement of those back office systems, such as ERP, supply chain management, and TMS software, as being fairly important to organizations' digital transformation. So we do have results from use cases and adoption from logistics service providers and carriers as well. And the logistics service providers, I would say that the results were essentially the same as shippers. The only significant difference in the ranking was that real-time tracking was even higher on the list for the logistics service providers. And that makes sense, as that's one of the main tasks that they're going to be performing for those shippers. As for carriers, as I said before, we had an entirely different list of use case options for them. And the top three were cargo tracking, driver and operator monitoring, and then the third was remote network connectivity.
Yeah, thanks, Mark. Agnieszka, what's the outlook for container freight volumes? You've talked about total trade. What are your numbers looking like for container freight specifically?
So the first quarter of 2023 is not a record one, actually dropped by 5%. So it is not extremely promising, but as I mentioned, the overall trade volumes are going to look better in the whole 2023. So we are looking at the rebound in the quarter 3 and quarter 4. And our overall estimate for whole 2023 is 0.7% annual. And we are expecting 2024 to be a better year, around 3%.
Yeah, so a similar story to kind of trade in total, which makes sense given how important container trade is for total trade. There's a question as to whether this reduced demand is hiding latent issues in containerized freight networks that maybe some of this reduced demand is covering up. I think there's probably a couple of parts to that. I think the first one is that there's a lot of new infrastructure coming online this year and next year in terms of new shipping vessels coming in. Those are generally the larger container vessels. They are also using more of the green fuels, whether that's the methanol systems that some prefer, LNG, which are liquefied natural gas, which has been rolled out already, and even kind of sail-assisted systems, so retrofitting to regular systems. I think the important point there is that there's a lot of extra boats coming on. The question is whether they will be, whether the older capacity, the less efficient capacity, will be taken off. It's only really once that begins to happen. So once we start to see scrapping rates, which we have colleagues in our maritime business who track that we'll be able to see what the true position is on the shipping side. On the port side, clearly, one of the challenges for a lot of the ports, particularly in the US, during the pandemic was the availability of information. So effectively digital port automation, so full port automation. I think we haven't really seen any new announcements from ports planning to digitize in the past couple of years in response to what we've seen during the pandemic. But clearly there's the opportunity for additional spending there. Perhaps staying with the visibility side of things, Mark, there's been a lot of talk about supply chain visibility. Are we actually at a stage where we really have 100% comprehensive real-time visibility, or is that just hoping too much?
Yeah, I think the short answer is yes, it's hoping for too much, at least at the present time. We surveyed companies about that, or we surveyed logistics service providers in particular about that. And a lot of them, I think it was about 7 in 10, said that, yeah, we have comprehensive supply chain visibility. We don't really feel that that's the case. I think a lot of it depends on what it means to be comprehensive. There are still gaps, and those gaps are shrinking. You mentioned the ports, and that absolutely makes sense. That's one of the places where there are still gaps in visibility, at the ports, in drayage, at the intermodal yards. So those gaps are still there, but they're not as large as before. And another important point, though, is when you look at digital transformation projects that are being deployed, supply chain visibility was actually pretty low on the list, but it was there in other use cases. So projects that rely on visibility were really high on the list. Projects like real-time tracking and dynamic routing for vehicles and cargo tracking. So I think it's still top of mind for a lot of the organizations when it comes to digital transformation. But yeah, we're not at 100% yet.
Yeah, and I wonder whether kind of 100% is ever going to be possible. I mean, forever is a very long time, right? But maybe what do you think are the missing links to get to better visibility? Is it just more companies doing it, or is something else needed?
I think it's a combination of things. More companies doing it. I think a lot of it has to do with who owns data and how that data gets shared, and the means by which it gets shared, and all the data sharing agreements that might be necessary for everyone to have access to that sort of comprehensive supply chain visibility data.
Yeah. Question for Agnieszka here. What is the outlook for the steel industry? And can we talk about the tariff situation?
Well, we can look at the basic steel imports to the US and manufactured steel, like iron and steel articles that we are having in our GTAS forecasting, and flat rolled products. So both of those, the change in Q1 2023 was very negative, of course. We are estimating the -15 in whole 2023 because Q1 was already a 20% drop. So this is a huge indicator for a basic steel. And if we are looking at the products like flat-rolled products of iron and steel, we could see a drop more than 30% in Q1 2023. So the whole year outlook is negative in our forecasts, like over 10%.
Yeah, and I think with regards to kind of putting aside the levels of steel, I think we have seen tariffs have a significant impact on trade flows in steel, in terms of just the which countries are buying more or less. There's also a question that we've been asked around what is the future for the Section 232 tariffs. So for those of you who aren't familiar, those are the tariffs applied by the US on imports from basically every country, but then applying a series of exclusions. So some countries no longer have to pay those tariffs. I think that steady reduction in the coverage of the tariffs is likely, but it's unlikely that the Biden administration are going to remove those tariffs altogether. I think one thing we have learned over the past couple of years is that the Biden administration is very happy to continue the tariff programs that were put in place under the Trump administration, even though they are being adapted in a variety of ways. One of the topics to watch is whether the US and EU can reach a green steel deal. And if they do that, we may see some further adaptations to the Section 232 coverage, because I'm sure if the EU get a green steel deal, I'm sure that other countries will want to get that with the US as well. I think one of the sectors that's been well ahead of the curve in terms of looking at sourcing green steel has been the automotive industry. On the basis of what we've seen in terms of trade flows in autos, those have certainly picked up, although in many cases they're still not back to the pre-pandemic levels. And we do still hear reports that are tracked by our colleagues in S&P Global Mobility around plants still having to go on hold occasionally because of the lack of the availability of specific semiconductors. I think it's worth saying for the semiconductor industry more broadly that we have seen something of a bifurcation over the past year that's likely to continue for a little while of the PC and mobile phone sector's demand really having cratered as a result of reduced demand for devices, whilst the demand for other sectors, whether that's mechatronics or for industrial robotics, or whether it's for the automotive industry for non-processor and memory systems, that has remained robust. When we've tracked the commentary from supply chain operators and the companies with regards to the demand for semiconductors from the personal computer and mobile phone spaces, those are expected to pick up later this year and into next year. Perhaps coming back to Mark, question here for those companies that don't yet have a digital transformation strategy, of which there was still plenty or just aren't going to do it. What's stopping them? Is it just willingness? Is it just senior management are Luddites? What's what's holding firms back?
The biggest challenge that we saw to digital transformation in our survey, by far, was not even close, was the skills and labor shortage. So with the pandemic, everything gone virtual and technical roles were in high demand across the board. So you saw a really high competitive market. And so shipping and logistics firms looking toward digitization, they had to not only compete with other shipping and logistics firms, but also with companies in many other industries as well. Going hand in hand with that, the survey found that technology outsourcing was happening to a large extent. So I think it was about 7 in 10 shippers said that they're currently outsourcing transportation technology. So that kind of makes sense. If they're having trouble hiring, then they're going to outsource it. The second biggest challenge, which again wasn't nearly as much as that first one, was legacy mindset, being that the industry has kind of historically been somewhat averse to technological change. So that's still kind of a hurdle for organizations to overcome.
Yeah, so clearly there's a lot more to digital than just buying software. And I think that kind of whole process improvement is an area that's not easily fixed overnight. Agnieszka, when do you expect volumes of trade to grow again in mainland China? And are there other regions that are growing particularly quickly?
Well, imports to mainland China are growing already. In Q1, we could see the global trade growth, the imports from United States growth, and those are two-digit numbers. For now, we are expecting 2023 to be around 10% growth. If we are speaking about the regions that are on the uprising curve in 2023, I will be speaking about Asia. I would add Australia to that. And surprisingly, as an exporter, maybe not as surprisingly, but we are not speaking about Africa often enough. So Africa is showing a very good result in exports in Q1 2023, and therefore the outlook for the exports in whole 2023 is positive.
Thank you for that. Mark, is there any place for generative AI in supply chain digital transformation or not?
The survey didn't ask specifically about generative AI, but it did ask about AI and machine learning as a technology that organizations were using. And the organization said that it was the third most impactful technology. And I can't remember, I know cloud computing was ahead of it, and I think connectivity was the second one. And then for logistics service providers, I believe it was the second most impactful. So they clearly see it as an important tool in digital transformation. In terms of projects or use cases that could take advantage of that, I can highlight a couple. So the top use case for shippers was purchase order management. So generative AI could help with the automated generation and creation of those purchase orders. So just like ChatGPT that you and I use when we're sort of messing around or whatever, it will in all likelihood require some oversight from humans, that automated generation of purchase orders. Another could be the further sort of deeper optimization of shipping networks and shipping lanes with the massive volume of data being generated on a daily basis there. And then on the transportation side, I could see fleet managers taking advantage of generative AI for sort of over-the-road route optimization for their vehicles and drivers.
That's great. Yeah, thanks for that, Mark. I mean, clearly, the adage that you might not lose your job to AI, but someone using AI might take your job is probably, I think, a salutary message for everyone involved in supply chains that you have to embrace these tools, not just wait and see. So thanks for that. All right, we're more or less at time, and we have covered a lot today. So all that's left to say is to say thanks to Mark and Agnieszka for joining us. Thank you for taking the time to join us today for the session. Hope you have a great summer season, and we look forward to you joining us again soon. Thanks very much, and goodbye.